In this lecture, we're going to be talking about liquidity. So what is liquidity? So liquidity describes the degree to which an asset or security can quickly be bought or sold in the market without affecting the asset's price. So when we're talking about liquidity and we're saying this thing is liquid, what we mean is you can sell a bunch of it without impacting its price. You have market liquidity and asset liquidity. For example, different markets have different liquidity types. For example, the Forex market is the most liquid market. So you can sell a bunch of a currency for another currency and you won't impact this currency's price. For example, you can go and exchange $1 billion Canadian dollars for US dollars. Easy. You know, Canadian to US prices aren't going to drop by a cent or even by half a cent, even by a quarter. It's not going to drop by anything because you sold a bunch of Canadian dollars. No, because it's such a big market. Okay. Now you have the stock market that's less liquid than the Forex market, right? So if you want to sell, $1 million worth of a stock, you're going to probably impact the stock's price, maybe slightly. Then you have cryptocurrencies that are even less liquid, right? So you've heard before, news that comes out, somebody sold a big amount of Bitcoins and it made the whole market crash. So, different markets have different liquidity types. You have the real estate market. Every market has different liquidity than the other market. Now, within each market, you have different asset liquidity. For example, in the stock market, if you're looking at a very liquid company like Facebook or Apple or Microsoft, you can sell big amounts of money without highly impacting the price of the stock. But there are some stocks that are very illiquid, that do not trade a lot. So these companies maybe trade a few hundred, a few thousand shares a day, compared to big companies who trade millions of shares a day. Well, if these companies, you go ahead and you want to sell $50,000 worth of stock, you might drop the price by 5%, right? So you have an impact on them. And it's the same thing in cryptocurrencies. Different cryptos are going to have different liquidity, right? For example, if I'm going here on CoinMarketCap, if I look at Bitcoin, Bitcoin is the most liquid, right? It's the one that most people trade. And because of this, you can go ahead and send an order to sell a big amount of Bitcoin, and you're probably not going to impact it by a lot. Now, if I go and I choose another coin, maybe I can go let's say the next page. I can go a few pages down. Let's say I go on page, 4. Okay. And I choose one of these coins here. Let's click on Rubik's. Well, let's actually find one that trades on Binance. So let me find one of the coins that trades on Binance that's not too liquid. So I'm going to click, well, actually, let's get to Binance. I'll find the Binance market. And let's see on Binance here. These are all the coins that trade. Let's say I go way in the bottom. And I'll choose one of the least liquid coins. Now, why are these ones less liquid? Well, for now, I'm looking at the volume. How much has been traded? So in the last 24 hours, Bitcoin, there was 313 million worth of Bitcoin traded. That's a lot of Bitcoin in the last 24 hours. Now, if I check for, other coins, some coins are trading, let's say NEO, 1.3 million. So that's like 300 times less. Crazy, right? But then if I keep going down, some coins only traded in the last day 100,000. And then some traded 50,000, 10,000. So you can imagine that a coin that traded only $1,000, okay? Or let's say Zcash. Let me find something USDT. I'm only going to look at USDT. To make it even simpler, I'm going to select here, no, not here, pairs, USDT, okay? Make it simpler. Okay, so we have, let's say, Gifto. I don't know what this coin is, but it traded $25,000 today. That's nothing. That's during 24 hours. Probably if I'm selling $1,000 worth of this coin, I'm impacting its price. Okay? Now, liquidity isn't only shown by volume, it's actually shown by the order book. If you look at an order book and you see a lot of buyers and sellers, it's liquid, because if you send the market order to buy or sell, they are going to absorb that order and transact with you, and the price isn't going to be impacted by a lot. But if you have a very thin order book where there's not a lot of orders, well, one big market order to sell or buy is going to impact the price by a lot. It's going to go through a lot of orders and the price is going to fluctuate wildly. The thing is, most of the time, volume and thickness of the order book is very highly correlated. So when something is trading a lot, there's usually a lot of orders, and when something isn't traded a lot, there's not a lot of orders. So we can go here and check this out. I can go on Binance, I can go on the advanced exchange, and I can look at Bitcoin USDT. So we'll go on USD, yeah, here, Bitcoin USDT, it's right here. So if I look at the order book here, I have a buyer who wants to buy here, just at this price, $225,000 worth of Bitcoin. So if a seller comes in and sells $100,000 worth of Bitcoin, the price isn't even going to drop by 60 cents. Here, you see somebody sold somebody sent a huge order and he got filled, but there's still 94,000 left. Now there's 45,000 left. So it can absorb a lot of, a lot of trades. And if I look at all the buyers, if I keep going down, I'm going to see a lot. 10 million, 7 million, 8 million, 15,000, not million, sorry. 15,000, 10,000. So a lot of buys here. And here, what is this? 3. So a bunch of them, 13,000, 5,000. All of these, and they're all cents apart. Now let's go and see this other coin, how thick the order book is. GTO. So let's go here. GTO USDT. Oh, look at this. Let's see here. On the order book, here I have a buyer who wants to buy for $149. Then another buyer, and this is trading at cents, right? So a buyer who wants to buy at $299. For $299. 500, 800, 600, 300, 300, 300. That's not a lot. 1,000. That's nothing. And look at this. If the price drops from here, let's say, let me put a lot of buyers. If the price drops from here to here, let's say just from here to here, from 12.68 to 10. Well, that's 20% drop, right? So if I want to calculate how big of a drop going down from here to here would be, for example, let's take a look. 0.01268, the price here, minus, let's say, if we drop all the way down here, so minus 0.00875, and then this divided by the initial price, 0.01268. That's a drop of about 30%. I don't know if you guys can see, or this is blocked by my face here. So I'll just move it here. This dropping from here to here is a drop of about 30%. And how much money would be required to drop this coin by 30%? Well, look at this. If I add all these quantities up, 150, 800, 1,000, another 2,000, another 2,000, 5,000. So a few 2,000s here. If I have like $20,000 and I send a sell order here, if I have $20,000 worth of this coin and I just send a sell order to sell at market, I am tanking this coin by 30%. That's ridiculous. And when we looked at Bitcoin, you saw that there was orders for over 250,000 and a bunch of orders for 20,000. So if I was sending an order to sell 20,000 of Bitcoin, Bitcoin would not move at all. And even if I send orders to sell Bitcoin, let's see here, let's go back on Bitcoin. I send orders to sell Bitcoin for $100,000. If you look at the distance from here to here, this is like we're dropping from $10,115 to $10,105. So it's a $10 drop over $10,000. So if you go $10 over $10,100, we're dropping by almost, it's nothing, right? It's nothing times 100. So we're dropping by 0.1%. It's nothing, right? So really, the difference in liquidity is huge. And this is going to be very important. Why? Because depending on the strategy that you're trading, you might want to trade something that's very liquid because you want to be able to get in and get out very quickly, right? Because if you're trading something that's illiquid and you want to get out quickly, you're going to impact the price and you're going to get a bad price for yourself, right? So you might not want to trade something that's illiquid for a specific strategy. But then for other strategies, you might want to look at something illiquid because maybe you are looking at things that are illiquid, and when somebody wants to sell something of it or buy something of it, and he just sends a sell order to sell and the price tanks, well, you as a professional trader or as a trader that's monitoring these coins, you're going to pick it up at a huge price. So if we were looking at this coin that we were just looking at, GTO, right? GTO. And somebody sends an order to sell for let's say 10,000, or let's say, like we said, 20,000, and the coin drops by 30%. Well, maybe you can pick some up at a 30% discount. And usually what's going to happen, the price is just going to go back up and then you would have made your money. So depending on the strategy that you're doing, you might want to look at liquid or more or less liquid. And we're going to see that in the strategy section. For different strategies, we look at different things. And again, strategy that's for something that's liquid is a strategy where you want to get in and out quickly. And a strategy that you're looking at more illiquid stuff is something that where you're waiting for an inefficiency or somebody to sell something and prices to deviate by a lot for you to get in and, capitalize on the fact that this coin is illiquid and that it could deviate by a lot just because of an imbalance between buyers and sellers at a specific point, and you can pick some up at a great price and make money that way. So this is going to do it for liquidity. So now you know what liquidity is, and I'll see you guys in the next lecture.